This is Friday, January 30th, 2026, the last trading day of the month, the last day of the week, and silver just crashed from $121 to $95, $26 gone in a matter of hours. Gold crashed from $5,600 to $4,950, $650 wiped off the board. If you're watching this and your stomach is in knots right now, I need you to stop. Take a breath. Because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. Silver crashed 22% this week, one of the biggest weekly crashes in years, and yet, right now, at this very moment, you cannot buy physical silver. The Perth Mint in Australia has suspended sales. The US Mint has suspended sales. The Royal Mint in the UK is out of stock. Dealers in India are defaulting on deliveries. Costco has purchase limits on metal bars. Let me say that again so it sinks in. The price is crashing, but you cannot buy the product. Does that make sense to you? Does that sound like a real market? In any normal market, when price crashes, supply increases. Sellers come out of the woodwork. Product becomes available. That is how markets work. Supply and demand. Economics 101. But that is not what is happening here. The price is crashing while supply is vanishing. The price is going down while the whole world is running out. Something is very wrong, and by the end of this script, you will understand exactly what it is. We think markets are rational. We think prices reflect reality. We think the number on the screen tells us what something is worth. That is the illusion. That is the lie they need you to believe. Because if you knew how the game actually worked, you would never play it their way again. This is not a market anymore. This is a controlled demolition, and you are standing in the building. Let me take you back to a time when silver was still treated like money, not paper, not promises, actual money. For most of human history, silver was the currency of the common man. Gold was for kings. Silver was for merchants, soldiers, farmers. It was real. It was tangible. It was honest. You could hold it in your hand and know exactly what you had. No counterparty risk. No bank failures, no fine print, just metal. But then something changed. Governments realized they could not print silver. They could not create it out of thin air. They could not inflate it away when the debts got too large. So they moved to paper, first backed by silver, then backed by gold, then backed by nothing but promises and military power. The dollar used to be redeemable for silver. Until 1964. Then it was redeemable for gold. Until 1971. Now it is redeemable for nothing. Just another dollar. Just another piece of paper. And once the link was severed, once money was divorced from metal, the manipulation began. Because paper can be printed, contracts can be written, prices can be controlled, not by supply and demand, but by whoever controls the printing press. Whoever controls the exchange, whoever writes the rules of the game. For decades, the price of silver has been set by paper trading, not by physical transactions, not by miners and refiners and manufacturers, but by banks trading hundreds of millions of ounces of paper silver every single day. Contracts, derivatives, futures, digital entries in a ledger. They are not trading real silver. They are trading promises, bets. Casino chips with no physical metal behind them. The paper market is like a poker game. Billions of dollars change hands. Fortunes are won and lost. But at the end of the day, most players never actually see or touch any silver. It is all just numbers, all just abstractions. And that abstraction is what allows the manipulation to exist. Because when you control the paper, you control the price, even if the physical metal is disappearing. Think about the scale of that. A handful of banks in New York and London can create infinite paper silver. They can flood the market with sell orders. They can drive the price down whenever they want, because they are not selling real metal. They are selling contracts, promises to deliver metal at some point in the future. Most of those promises will never be kept. They will be rolled over, settled in cash, closed out before delivery. The game continues. The illusion persists. But there is a problem, a crack in the foundation. Physical silver is real. It cannot be printed. It cannot be created with a keystroke. It has to be mined, refined, transported, stored. And right now, the physical market is breaking down because the world is waking up and they are demanding delivery. Let me show you what is actually happening behind the curtain. There are two silver markets, not one, two. And these two markets are telling completely different stories right now. The first market is the paper market. This is COMEX. This is where futures contracts and derivatives trade. This is where hedge funds and banks and institutions play their games. Billions of dollars worth of silver trades every day. But it is not real silver. It is paper promises. The second market is the physical market. This is where actual silver trades, real metal, coins you can hold, bars you can stack, the stuff that exists in the real world. And here's the critical point. These two markets are supposed to be connected. The paper price is supposed to reflect what physical silver is actually worth. But right now, they are completely disconnected. The link is broken. The paper market says silver is $95. The physical market says you cannot have any at any price. One of these is lying to you. Which one do you believe? The computer screen or the empty shelves? Let me show you the evidence. Perth Mint, Australia. One of the largest and most respected mints in the world. They have been producing gold and silver bullion for over a century. Governments trust them. Institutions trust them. On Thursday morning, before the crash even happened, when silver was still trading near $117, they sent a notice. I have seen this notice. Here is what it says. Due to increasing worldwide demand for silver bullion products, we have a large backlog of orders. As a result, we have decided to pause taking wholesale orders until February 23rd to clear the back orders. Read that again. Let every word sink in. Increasing worldwide demand, not decreasing. Increasing. Large backlog of orders, not surplus inventory. Backlog. Pause taking orders, not discount sale. Pause. This was sent when silver was still at 117. Before the crash, when everything looked fine on the surface. They are also implementing monthly allocations to ensure all regions receive stock. Monthly allocations. That is rationing language. That is what you do when you do not have enough product to meet demand. This is not a company having a bad day. This is the Australian government mint telling the global market that they cannot keep up. Australia is one of the largest silver-producing nations on Earth, and their own mint cannot get enough silver. Let that sink in. And then the crash happened. Silver dropped from 117 to 95, a $22 discount in a matter of days. Now think about this logically. If the Perth Mint was already at breaking point when silver was at 117, what happened when silver crashed to 95? Every smart investor in the world just saw a 22% discount on an asset that mints cannot even keep in stock. What do you think they did? They bought. They bought everything they could find. The crash did not reduce demand. It created a tsunami of new demand. The lower the price, the faster the metal disappears. Now let me show you the United States Mint. The U.S. Mint has suspended all sales of silver numismatic products. Their website shows products as temporarily unavailable. When you call their customer service line, they tell you they are updating prices. But here is what actually happened. Silver prices moved so fast that the mint could not keep up. They were selling silver eagles at $91 when the spot price went above $90. They were losing money on every sale. So they stopped. They suspended everything. And when products came back online, the price had jumped from $91 to $169, an 86% price increase overnight. The 2026 American Silver Eagle that was supposed to release in January has been delayed to late February. Subscriptions are already sold out. This is the official government mint of the United States of America telling you they cannot sell you silver. But it gets worse. India, one of the largest silver markets in the world. Right now, dealers are not just running low on inventory. They are defaulting on deliveries. That means they are taking orders, accepting payment, and then failing to deliver the product. People are paying for silver and not receiving it. The headlines coming out of India are shocking. Not even a sliver of silver available. Amazon India sellers are defaulting on silver deliveries. People are posting screenshots of their orders being cancelled after payment was already accepted. This is not a supply issue anymore. This is a breakdown of the physical delivery system. The machinery is seizing up. The gears are grinding to a halt. And it gets even worse. The Royal Mint, Britain, the official mint of the United Kingdom, one of the oldest mints in the world. They have been producing coins for over 1,000 years, out of stock on silver bars, even 1 kilogram bars. The basic, most common format, gone. When major sovereign mints across multiple continents are all experiencing the same issues at the same time, that is not coincidence. That is not bad luck. That is a systemic crisis. And if you think that is bad, wait until you hear what Costco is doing. Yes, Costco, the wholesale retailer, the place where you buy toilet paper and rotisserie chicken. They sell silver bullion, and they have implemented purchase limits. You cannot just buy as much as you want anymore. They are limiting transaction sizes. Costco is rationing silver. A retail store known for selling things in bulk is now limiting how much silver you can buy. Why would they do that? Because demand is overwhelming supply. They have to ration what they have. They have to make sure everyone gets a little bit. Because if they did not, the first buyers would clean out the entire inventory. But here is where it gets truly alarming. Let me show you what is happening in China. And this is the part that should genuinely scare you. The Shanghai Futures Exchange data from today, January 30th. Fresh data. Real numbers. The SHFE silver vaults currently hold 455 metric tons of silver. That is 14.6 million ounces. Sounds like a lot, right? It is not. And here is the part that made my jaw drop. In one single day, 26.94 metric tons were removed from the vaults. Almost 27 tons in one day. One single trading day. I need you to understand how insane that number is. 27 tons is approximately 870,000 ounces removed in 24 hours from one exchange. At this drain rate, the Shanghai vaults could be completely empty in less than 3 weeks. For context, annual global silver demand is over 1 billion ounces. The Shanghai vaults now hold just 14.6 million ounces. That is barely 1% of annual demand. That is nothing. That is a rounding error. And nobody in mainstream financial media is talking about this. Nobody. Now here is what makes this truly frightening. China has already restricted silver exports. They have classified silver as a strategic national security asset. They are treating silver the same way they treat rare earth minerals, the same way they treat materials for weapons and AI infrastructure. So think about what China is doing. They are restricting exports. No silver leaves China. And they are draining their own exchange vaults, taking physical delivery, moving metal from public warehouses to private storage. What does that tell you? It tells you that China knows something we do not. They know what is coming. They are hoarding physical silver while the paper market crashes. They are preparing for something. While Americans are selling paper contracts and crashing the price, China is taking physical delivery of every ounce they can get their hands on. One side is selling paper. The other side is hoarding metal. Which side do you think knows what silver is really worth? Now let me tell you who is doing the selling. This is perhaps the most important part. Pay very close attention. Nearly all of the selling this week in silver has occurred during US market hours. Not Asian hours when Shanghai and Hong Kong trade. Not European hours when London is active. US market hours. When New York wakes up and COMEX opens. When New York opens, silver dumps, red candles, aggressive selling, price collapses. When New York closes, silver stabilizes. Sometimes it even rises during Asian hours. Then New York opens again, and the selling resumes. This pattern has repeated every single day this week. It is not random. It is coordinated. The US sells and dumps digital derivatives and paper promises. The rest of the world buys and accumulates physical metal. Stop for a second. I need you to really think about what I just said. American banks are selling something they do not have. They are creating digital silver out of nothing, pressing buttons, moving numbers on screens. Meanwhile, People in Asia and the Middle East are loading physical bars onto trucks. They are taking delivery. They are draining vaults. They are removing real metal from the system. One side is playing a video game. The other side is taking home the prize. American banks and institutions are flooding the paper market with sell orders, driving the price down. They are selling contracts for silver they do not have. They are creating supply out of thin air with a few keystrokes. Meanwhile, Asian buyers in China, Japan, and India are buying real physical metal. Middle Eastern buyers in Dubai and the UAE are buying real physical metal. The paper price goes down. The physical metal disappears. This is not new. This has been the pattern for as long as I can remember, for years, for decades. The West sells paper, the East buys physical. But right now, it is happening more aggressively than ever before. The disconnect between paper selling and physical buying has never been this extreme. This is not a free market. This is a rigged game. And if you do not understand how the game works, you will be the victim of it. You will sell your physical metal at the bottom because the paper price scared you, and someone in Shanghai or Dubai will happily take it off your hands. Let me show you the lease rates. Lease rates are what it costs to borrow physical silver. In normal markets, lease rates are near zero, around 0.3 to 0.5%. Right now, silver lease rates have exploded. Some reports show 8%. Others show rates as high as 39%. 39% to borrow silver. That is a panic signal. That means physical silver is so scarce that holders are demanding massive premiums just to temporarily lend it out. When lease rates spike like this, it means the physical market is broken. It means there is not enough real metal to go around. It means the bathtub is almost empty. What we are witnessing is a complete breakdown of the paper-silver pricing mechanism. For decades, the price of silver has been set by paper trading. Banks trade hundreds of millions of ounces of paper silver every day. The actual physical market is tiny by comparison. This has allowed the paper price to be manipulated, suppressed, controlled. Something has fundamentally changed. Physical demand has overwhelmed the system. Mints cannot keep up. Vaults are being drained. Dealers are defaulting. Lease rates are exploding. The paper market claims $95, but the physical market is sending a different signal. Silver is becoming unavailable at any price. One of these realities must break. Either paper prices rise to reflect physical scarcity, or the physical market fractures entirely. I believe we are approaching that breaking point, the moment when paper promises collide with real-world shortages. When that happens, the price adjustment will not be gradual. It will be violent. We have seen this before. In 1979 and 1980, paper and physical silver disconnected. Dealers ran out. Premiums exploded. Silver was impossible to find even as prices surged. Eventually, the paper market had no choice but to catch up. Silver rose from $6 to $50 in months, one of the most dramatic commodity moves in history. This is not a prediction of the same outcome, but the same dynamic. Paper markets can suppress price, delay reality, and create artificial crashes. They cannot create metal. They cannot mine supply into existence. If you hold physical silver, do not panic. The paper price is noise. Scarcity is the signal. If you hold paper claims, ask yourself one question. If everyone demanded delivery, would the metal actually be there? Promises are easy to print. Silver is not. If you are trying to buy physical silver, good luck. Premiums are exploding worldwide. Japan is paying nearly 60% over spot. Dubai is closer to 40%. The paper price might say 95, but the real world price is 120, 130 or higher. If you can even find supply. And if you do, that inventory will not last. Here's the paradox most people miss. The lower the paper price falls, the faster physical silver disappears. Lower prices increase demand. Rising demand drains already thin supply. The crash is not fixing the shortage, it is accelerating it. Paper prices and physical reality are moving in opposite directions, and eventually something breaks. This is not a conspiracy. It is visible stress across every major source of physical silver. The Perth Mint suspended sales. The U.S. Mint repriced dramatically. The Royal Mint ran out. India saw delivery failures. Shanghai vaults lost massive tonnage in a single day. Lease rates surged. These are not isolated issues. This is a global supply squeeze. Timing matters. This happened on the final trading day of January, after one of the strongest months for silver in decades. Big players shake confidence at moments like this to force weak hands out. Fear creates opportunity for them. The price fell. The metal vanished. One of those signals is lying, and it isn't the empty shelves.